So last time we stopped at inventory, right? So we did in balance sheet item, we did cash, we did AR, and we did inventory, right? So today we will start with next line item, which is investments. Okay. Investments can be done by the company in debt or in equity, like in other entities, right? So, if we talk about investment in debts, debt generally means bonds or the securities. Bonds, securities. So, there can be three intentions to invest in the debt. One is held for trading. One is held to maturity, right? And third one can be the one which has been held to maturity can be considered as available for sale before the maturity is there, right? In between, your intention was to keep it till maturity, but in between your intention changed and you want to sell it now, right? So for held for trading, generally the journal entries are very simple. Like when you invest, it will be investment held for trading to cash, right? Then um, now what happens? These securities which are held for trading are reported at fair market value at the end of the year. So, for example, let's say you bought this investment for $1,000, right? On maybe June 1, 2025. Let's say when you are closing this book, like on December 31, 2025, the fair market value of this investment goes up by 12 to $1,200. So 200 of the profit you have to report, which is an unrealized profit or unrealized gain. So that you will report by increasing the investment. So investment, you can either add this $200 in investment HFT or you can create investment valuation account for the same. Investment valuation 200 to gain 200. Okay. So in short, held for trading securities are reported at fair market value. Now, if we talk about held to maturity are first you calculate the present value by using discounted cash flow method. Discounted method. Okay. How it is calculated? So let's say you have a bond which have the value which will give the interest of $10,000 every year. And at the end of the year, you'll get $100,000. Okay. Now, how much would be the investment value in on today's, like in year zero? For that, you have to calculate the present value of all these inflows of the cash. 10,000 each every year and $100,000 on year 5. Okay. So obviously it can be at discount or at premium based on the whether it is the rate of discounting is more than the actual interest rate or less than the actual interest rate. So if you see here, actual interest rate is 10%, which is 10,000 of 100. So you will get $100,000, right? So every year you are getting 10%. So this is your actual or the spot or the bond rate or the face value rate. Okay. And market rate can be either 8%, 10%, or 12%, maybe higher or lower than this, right? So if let's say the market value is 8%, then what will happen? Actually, you are getting 10% through this investment, but market value is 8%. That means you have to pay 2% premium on it, right? If the market value is higher, then obviously you will ask for 2% discount. Okay. So based on this, the future value is equal to present value into 1 plus r raised to the power n. This is a formula, basic compound interest formula that you will use to calculate present value. We have to calculate present value at year 0. So present value will be fair value divided by 1 plus r to the power n. So for first year, fair value, future value is $10,000 divided by 1 plus r. R here will be the discount rate. So if we take 8%, then it will be 1 plus 8 by 100 raised to the power n. N is 1, right? So 10,000 divided by 1.08 to the power 1 for first year. For second year, it will be raised to the power 2. For third year, it will be raised to the power 3. For fourth year, 4. And for fifth year, for both, it will be 5, right? And after adding the present value of all of these, you will get the bond value in year 0. Let's say that value is $120,000 coming out as. Okay. So this is the value that will be reported at the time of buying the held to maturity. Okay. And every year end, this value will be amortized. So this 20,000 extra should be amortized and become 0 at the end of fifth year, so that this 120 becomes $100,000. Because here, if you see, we are showing that we will receive $120,000, right? But in actual, we will be receiving only $100,000 plus these 10,000s, right? So we need to amortize this 20,000 every year by creating amortization expense to premium. Okay. So cash paid is 120. So here we will be having investment 100,000 and premium 20,000. So this 20,000 will be amortized throughout the 5-year program. Okay, this is how the held to maturity bonds are reported. Although this calculation in detail is not in syllabus, but just to make you understand how these are reported, I've shown you. Lastly, AFS or available for sale security. Last time also we discussed this, that whatever unrealized gain or losses will be there, it will be reported in OCI, other comprehensive income. Right. So these are how to report for the investment in debt. Then comes investment in equities.